Welcome back to Watch Your Assets, where we've got your money on our minds. I'm your host, Stephanie Bracken, and today we are doing a special Valentine's Day episode. I have my pink on for Valentine's Day. I love is in the air, and I wanted to talk about the perks of getting married. So when we're thinking about finances, sometimes marriage makes some sense from a financial perspective. Now, I know some people think that they don't believe in marriage, or, they have their own thoughts personally and their own convictions about marriage. But I want to talk about why marriage might make sense for couples who are in long-term committed relationships, why marriage might make sense from a financial perspective versus two single people living in a house together. So this is, again, I don't want to speak from the personal side of things. I am purely talking about the financial side. So I just want to make that very apparent. And I also don't want you to think if you're single that you have to just go out and marry the first person that you meet. So I want you to, if you're in a committed relationship and you know you're going to spend the rest of your life with this person, it might make sense to, again, get married just from the financial side of things. So there's a couple different things that happen when you get married. So first of all, let's talk about the cost of weddings because weddings they can be very, very expensive. But I think a lot of the times, especially my generation, I don't know about the older generations, but my generation, because we live in this social media era, we are very much about the aesthetics of everything, about the wedding and being able to post and have content for this really special day in your life. And that's a wonderful thing to have, but sometimes it comes with a really high price tag. As soon as you say the word wedding, every vendor immediately ups their prices. Then that's kind of the trend across florists, videographers, photographers, getting any kind of suits and dresses, your cake, your catering, the venue, all of this stuff that goes into planning a wedding costs money. And I don't know the average cost of a wedding, but they did an interesting study that found that there's actually a negative correlation between how much money you spend on a wedding versus how successful your marriage will be. They found that people who maybe just go to the courthouse, maybe have a small ceremony that only costs them a few, maybe $1,000, are more likely to succeed in marriage than someone who spent $30,000 to $50,000 on a wedding. Because at the end of the day, it is just one day. It's a party, right? And I want you, if that is your hope and your dream is to have a grandiose wedding, I want you to have that. But if you're having to go into debt to fund this wedding, this one day of your life, you might not want to start your marriage out that way. And I think a lot of the times, too, people see this wedding and they're planning for the wedding and they're not planning for the marriage on the other side of it. There's a lot that goes into a marriage. Marriage is a lifelong legal commitment that you're making to the other person. A wedding, again, is just a party. It's one day. So you really have to think about what's the bigger priority, and remember that on the other side of this wedding, there's a person that you're going to be spending the rest of your life with that's going to be the mother or the father of your children, that's going to be your lifelong partner, that's going to watch you have to deal with your parents passing away maybe, or a sibling, or you might have to watch the other one pass away or get sick. So you, in sickness and in health, that's a real commitment that you're making to somebody. So it's not something that should be taken lightly, and it's woohoo, this fun wedding. Like, yes, that's a really wonderful celebration, and you should be celebrating the love behind the wedding. But at the end of the day, if it makes financial sense to not go into $50,000 of debt just to fund your wedding, go to the courthouse. I am so about going to Vegas and just having the two of you elope or something like that, and then you can just couple that into a honeymoon at the same time. So I'm very much about being financially conscious about a wedding, because there's a lot of wedding culture that's really gotten blown out of proportion for some reason in today's society. And again, I think a lot of it has to do with social media, but it's also just the fact that vendors know they can charge whatever they want to, and so they're gonna charge you. So that's something to consider as you're getting into a marriage, is the wedding itself. But then let's think about the benefits of a marriage once you're over that hurdle. So when you get married, you can take advantage of a higher standard deduction for your taxes. So if you are two single filers and now you come together and you're going to marry filing jointly, your standard deduction doubles. So whatever it is in that particular calendar year, you're going to see an increase in your standard deduction when you file your taxes, meaning you could potentially get a bit of a tax break when you're married. The tax brackets also expand whenever you are married. So I don't know the brackets off of the top of my head and the thresholds into the next one, but the 22, the 24% bracket where a lot of the middle class America lives, those expand whenever you are married. So the chances of you not bumping into a higher tax bracket go up. Now, if both of you are high income earners, then you might bump into a higher tax bracket, and there's not much you can do about that, but it's going to really depend on your situation. But a lot of the times, filing your taxes married, filing jointly is going to be a tax benefit to you. But that's really going to be important to talk to an accountant about of what makes the most sense for my filing status. Now, if you have children from other marriages, if you have a blended family, sometimes it makes more sense to have one person file single and the other one file head of household, but it's really going to depend on your situation. But if you're just coming together, newly married, don't have kids from another marriage, and you're just starting out, married filing jointly can be a really great tax benefit to both of you. You also might be able to take advantage of itemizing your deductions versus taking the standard deduction. So I just mentioned that the standard deduction is higher. However, whenever you start doing things like buying homes, if you have student loans, there are things, and having children, there are deductions and credits that you can start to take advantage of that increase as you get married, and you might notice that you can itemize your deductions. The standard deduction, I think, for married couples is around $32,000 for this year. So if you have a home that you are paying interest on the loan or the mortgage, if you've paid more than $32,000 worth of interest, you can itemize your deductions and actually get even more of a tax savings. But it's going to really, again, it's going to depend on your situation. So I don't want to make that blanket recommendation that itemizing is always going to make sense. But your tax preparer, or even if you do your taxes on TurboTax, it's going to know which one is right for you. So it'll know that you want to put all these deductions in, but then it'll tell you, hey, this is more advantageous is to take the standard deduction or not. So that's one thing to consider, is taxes are going to be a really big part of this. The other thing that you're going to be able to take advantage of is contributing to an IRA or a Roth IRA. This is going to be another one of those things that the phase outs extend a little bit in terms of how much you can make and still contribute to a Roth IRA. When you're single, those again are a little bit squished. So whenever you're taking two incomes into account, you can hypothetically contribute more to, or contribute to a Roth IRA for longer, quote unquote, for a more extended income source versus if you're a single filer. If you are over a certain threshold of income, you can't contribute to a Roth IRA anymore. So just keep that in mind. I think I've talked about that in other episodes, but the phase out for when that starts to take effect of when you're not going to be able to contribute to a Roth IRA anymore, that phase out goes up whenever you get married. The other thing, too, you can take advantage of with IRAs is even if one of you is working and the other spouse stays home, you can still contribute to two different traditional IRAs no matter your income. So as long as one spouse has earned income, you can both contribute to an IRA up to the max for that particular year. So that's something else that you can take advantage of. There's never any kind of income limits on being able to contribute to a traditional IRA. So as long as one spouse has earned income, you both can contribute to an IRA. So that's something else. So you're going to be able to compound your savings potentially into that retirement bucket, even if only one spouse in the household works. I do think you have to file married filing jointly if you're going to take advantage of that strategy, which makes sense, right? Because if you had someone who was filing single and they don't report any income, you can't contribute to an IRA. So I do think you have to file married filing jointly on your taxes to be able to take advantage of that strategy, but something to keep in mind that even if that person does not have a retirement plan through work, if they're not working, or if both of you are working and neither of you are covered by a traditional 401k, 403b, something like that at work, you're still going to be able to contribute to these IRAs. So that's a really good thing to take advantage of just to compound your savings over time. Next, let's talk about Social Security. So whenever you are married, you can take advantage of spousal and survivor benefits on Social Security. These are two different things. So whenever let's just call it the higher income earner of the household, let's just say their Social Security benefit is $3,000 whenever they reach full retirement age. Let's say the other spouse never worked, never paid into Social Security. When that spouse who never worked, when they reach full retirement age, they are going to receive half of that person's, the other working spouse's benefit. So they're going to get $1,500 from Social Security if they file at their age 67, which is the full retirement age. If the spouse who wasn't working takes their benefit a little bit earlier or elects that spousal benefit a little earlier, that benefit is going to be reduced a little bit. It's not going to be quite half, but it's still going to be better than nothing, because if you haven't paid into Social Security, you want to be able to get some kind of benefit, and Social Security has that safeguard in place where they're not going to leave a spouse destitute for that piece of income that they otherwise would have missed out on if they weren't married. Now, again, this is something that you have to be married to take advantage of. So if you're not married, there are no spousal benefits. It doesn't matter if you have you've been in a partnership for 30 years. If you're not legally married, this is not a strategy you can take advantage of. So that's something else. If you are, if your benefit on your own is about $900 a month, let's just say, and you're single, that's your benefit. But if you're married, filing jointly, instead of $900 a month, you can step up to the higher of your own benefit or your spousal benefit. So again, if it's that $1,500, you can step up to that $1,500. Now, you don't get both. You don't get $900 and the $1,500. You just get one benefit, but you're going to step up to the higher of the two. So that's an advantage too. Again, if you're the lower income or the lower earner of the household, that's an advantage for you. Then, if one of you passes away when you're married, there are survivor benefits that you can take off of Social Security under the assumption that the person who passed away was what's considered fully insured by Social Security. So this means they have 40 credits of working history or 10 years of working history. If that person passes away and you are married, you will be able to collect some survivor benefits off of them. Social Security gives you a death benefit of $255. Don't know where they got that number from or what that's really going to do in the grand scheme of things, but they give you a death benefit. If you have underage children, they also will get a death benefit. Then as a surviving spouse, you'll be able to collect the higher of your own benefit or the other person, the person who passed away's benefit. You, again, don't get to take advantage of both, but you can potentially step up to a higher benefit than you were receiving when that person was alive. So again, they're trying to protect spouses who are widows now from being left, again, destitute. They want to make sure that that spouse is provided for. Going back to the minor children, if you have minor children in the household, you can collect that spousal benefit at any age. But it turns off when the child turns, it's either 16 or 18. Don't quote me on that. But when the child reaches a certain age, your benefit is going to get shut off, and then you can you can start collecting again your benefits whenever you turn 60, under the assumption that you didn't get remarried before that point. I think there's some kind of reduction, or maybe they eliminate benefits if you got married before age 60, but after age 60, you're allowed to collect those benefits again. And then also the minor child is going to also be able to get some benefits off of that person who passed away, off of their benefit. Depends on what the benefit is. There's family maximums that can be taken into account. Social Security is very convoluted with their rules. It's really hard to get a good estimate unless you talk to them directly. We can give you some estimates, but it's most beneficial to talk to them about what you'd be entitled to should something happen. But overall, if you're not married, you can't take advantage of any of these benefits. I think they'll provide for a child, but they may not provide for you, the partner, who is not a spouse. So that can be something that you want to keep in mind as we're thinking about retirement planning, is what's Social Security going to look like, and does that make sense for us to get married for that benefit? Another thing with survivor benefits, if one of you has a pension, If you get a monthly annuity payment from whatever the company was that you work for, if you're a teacher, if you work for the federal government, if you're in the military, if you work for a private sector company that offers a pension where you're going to get some kind of monthly benefit, a lot of the times they also offer survivor benefits to the surviving spouse. So if one of you was working and you're able to collect on a pension and you pass away, then the surviving spouse would continue to collect a certain percentage of your benefit. It varies based on the plan. It varies based on your employer. A lot of the times, employers, like for teachers, for example, you can take 100% survivorship on your pension. It does decrease your benefit a bit, but if something were to happen to you, your spouse continues that income at the exact same rate. So that's something to consider as well. Or maybe it's 75%, 50%, 25%, something. But you'll be able to weigh your options as you're getting ready to retire. I think for the federal government, they automatically put on a 50% survivor benefit. And if you want to waive that, the other spouse has to sign some kind of form that says, I want to forego my survivor benefits on this pension, which sometimes makes sense for those people if both of them have pensions, both of them are about the same age, and they may not need a lot of that income for survival. Maybe it doesn't matter to take the survivor benefits, but typically we recommend some kind of survivor benefit just because life is so unpredictable. You have no idea what's going to happen. You could walk out of the doors and get hit by a bus tomorrow, and then what happens? So we want to plan for the unexpected, and that's one of those things that we will plan for. But again, if you're not married, even if you're a partner, you can't get those survivor benefits on your pension. So most of the time, it's usually a spouse. Something else to think about is your health and other insurance coverages. A lot of the times you can, if you're married, you can get on your spouse's health insurance plan, and maybe that'll cut the costs of some of those premiums that you'll pay with every paycheck. Car insurance rates tend to decrease as people get married. I saw something that said married people save on average 4 to 10%, which doesn't seem like that much, but in the grand, it's dollars every month, but over time that's going to add up. So if both of you have good driving records and you are, pretty safe drivers, you're probably going to see a decrease in your car insurance. Same thing with health insurance, like I said. Other other coverages may decrease just depending on your income, your credit score, all that good stuff. You also might have increased borrowing power on loans because you're going to be able to account for two incomes probably if you're going out and buying a home. You might have more resources to pool together for that down payment on the house. And because you're accounting for two credit scores and two, borrowing histories, you might get better rates. So whenever you're thinking about that, it's probably good to sit down and review your credit scores, review buying power, review what you both have saved up, what you have coming into the marriage, so that you can pool those funds together to fund larger goals like a home. That's of course something that most people, whenever they get married, want to do is buy a home. So doing that on your own can be a little challenging sometimes, but whenever you have two incomes to account for the mortgage, you're probably going to get approved for more, a larger lump sum, if you will, of a mortgage balance, and you're probably going to be able to afford more of a payment because the debt to income ratio is going to expand. Along with homes, something else you'll be able to take advantage of whenever you go to sell your home at some point in time is an increase in the capital gains exclusion. Whenever you go to sell your home, there's a really good chance that you're going to incur a capital gain on the property. What that means is, assume you bought this house for $100,000. You put a lot of work into it, and with market valuations, everything like that, what's the value of all the homes in the neighborhood? Let's assume that your house is now worth $250,000 when you go to sell it. You're going to have a capital gain of $150,000 that needs to be reported on your taxes. But as a single filer, you can exclude up to $250,000 of capital gains on the sale of your primary residence. Now, if you have rental properties and you go to sell those may not be included in this depending on the use of those properties. If you rent it out for most of the year, it may not be included in this capital gains conversation. But we're talking about your primary residence. For primary residences, every person gets $250,000 that they can use towards the gain on their home. Meaning, if you have a gain of $150,000, you would not owe capital gains taxes on that property when you go to sell it. When you get married, that capital gain exclusion doubles. So instead of $250,000 you can exclude, you can now exclude up to $500,000 of capital gains. This probably matters if you buy a home that is larger than you would have been able to afford if you were single. Plus, again, the market values, the work you've put into the home, the time you've held the property, yada, yada, yada. All of this contributes to what the home is worth, of course. And that's going to matter. If you have a home where you purchased it for $100,000 and it's now worth $750,000, now we're getting into that where that exclusion is really going to matter. Because now instead of owing, $600,000 of capital gains, 650, I don't remember what I said for the home purchase or the sale price, $650,000 of capital gains, you can subtract away $500,000 of the gains. So now you only will owe capital gains taxes on $150,000 of that. So that's going to really lessen the tax burden that you might experience when you go to sell your home. So keep that in mind too. Something else, and this is going to be a little more nuanced because this may not apply as you're getting into the education side of things, but if you're married and you're a student and you're applying for federal student aid, FAFSA, sometimes, depending on assets and depending on income, it may benefit a young student to get married to not have their parents' income be accounted for anymore, depending on what that situation is. Now it's dependent on the student and their spouse. But that's going to be really, really nuanced. So that's going to be something you'll want to explore. If you're in your 30s, 40s, and you want to go back to school and you're married and you have, both of you are pretty high income earners, FAFSA is probably not going to provide you with too much federal student aid. But if you are a young couple just starting out, don't have much income to report, don't have many assets to report, you might be able to take advantage of some grants and some other federal aid that is able to be provided, given, again, income sources, things like that. But it'll depend on, again, it always depends on your unique situation. So that's definitely something that is good to explore or talk about with someone as you're getting ready to go to school. But most 18-year-olds probably aren't getting married, so this may not apply. But in a situation where you are young and you want to get married, it might make sense to get married and apply for federal aid as a married couple. There's also the possibility that as you get married, your living expenses might become a little more affordable versus two people who live independently. Because again, under the assumption that you're going to pool some, if not all, of your finances together, you're going to be able to keep really good track of the money that's flowing in and out of those accounts. You're going to be able to probably maybe consolidate some accounts, consolidate some debts, just pay things off and work towards bigger goals because you've pooled your resources together. And living under one roof, you have probably a larger budget for things like groceries, utilities, because you have two people living in the household. But you may notice a reduction in some of those benefits or in some of those expenses because instead of paying for two cable bills, if you're living independently, now you just have one cable bill. You just have one electric bill. You just have one water bill, things like that. Again, grocery bill probably going to increase, but maybe not as much as you would think it would. But it may save you a little bit of money from that side, plus the benefits of taxes that you'll pay a little bit less in taxes throughout the year probably when you're married filing jointly. So these may lead to more disposable income that you'll be able to put towards large purchases, kids, funding college, bigger goals, a new car, whatever that looks like. So that's something that it's something to be reviewed, is all I'll say. Because again, it's going to depend on you, but it's something to be reviewed as you're sitting down and you're looking at your finances, which I would hope you would do before you get married and not having these conversations after you get married. One other one that's maybe not so relevant today And people don't like to think about this. We've talked about this. I talked about this in my episode with Dan Carr. He mentioned, people don't like to think about their own mortality, right? We don't like to think about our estate plan. We don't want to think about dying. We don't want to think about incapacitation. We don't want to think about all these things that could happen to us as we get older, or if, again, in the event that, we get into an accident, something happens. But this is going to be a really, really crucial piece of the puzzle too, whenever we're thinking about the benefits of getting married. So let's talk about inheritance taxes first from the estate side of things. If you're married, that person's assets, the person who passed away, all of their assets, if you put beneficiary designations on them, things go into your will under the assumption that you want to leave most of your assets to your spouse. There is an unlimited marital transfer of assets. They come to the spouse tax-free, as if then the person who is surviving continues to hold on to those assets as if they were their own. So if you weren't married, on the other hand, you would have to pay inheritance taxes on that money, depending on what state you live in. It's in Pennsylvania, we have inheritance taxes, but it's going to depend on the state you live in. But your spouse may save in inheritance taxes depending on the state they live in. If you're not married, again, that person is going to have to pay inheritance taxes on all of those dollars that they have inherited from you. So that can be a real big point of contention almost whenever, and it's not going to matter to you because you're dead, but that person might be a little bit angry that they have to pay inheritance taxes on all of this money when you guys could have gotten married, even if it's when that person's on their deathbed. Not to be morbid, but if you get married when before that person passes away, now you can legally inherit all those assets as their spouse and not have to pay any taxes on that money. Then if we're thinking about retirement assets, if you're a spouse beneficiary, you can, again, inherit that IRA, 401k, 403b, TSP, whatever that is. You inherit that as your own. If you're under the required minimum distribution age, you do not have to take any kind of required distributions out of those accounts until you reach your own RMD age. Depending on how old or how much you need of that money, though, you can always structure an IRA like a beneficiary IRA if you need to take money out before you are 59 and a half, depending on how old you are. Before 59 and a half, typically, there are penalties associated with IRA distributions. I'm speaking about traditional IRAs. Roth IRAs will not have this penalty after 59 and a half. But before 59 and a half, there's usually a penalty on traditional IRA money. And when you are a beneficiary, a non-spouse beneficiary typically, you can pull money out of that IRA without any penalties. You will pay income taxes on that money, but you won't owe any kind of penalties. When you're a spouse, again, if you're under 59 and a half and you need money from a retirement account, you can set up a separate beneficiary IRA for yourself and take distributions from that account. Pay taxes on it, of course, but you won't have the 10% penalty. And then once you're 59 and a half, you can roll that back over into a traditional IRA and continue to hold that money as if it were your own. So there's a little bit of nuance that happens whenever you're a spouse, that you can take advantage of some different strategies for how to access that retirement money after that person passes away, should you need it. Whenever we're thinking about, again, beneficiaries, if you're a non-spouse, beneficiary IRAs have to be depleted or emptied within 10 years of inheriting the account. So if that person passed away in 2026, the clock starts in 2027. You have 10 years from 2027 to get all of that money out of that traditional IRA. So if you're a non-spouse, again, that's going to apply to you too, even if you're their partner. So it's going to really depend on your situation. It's going to depend on that person's assets, but this could be a way to save you in taxes, save you in unnecessary distributions if you don't need that money, to allow those accounts to continue to grow in the markets over time. It's a better strategy that way usually, because depending on what you make, it might bump you into a higher tax bracket to take those distributions out. But again, if you needed them and you're a spouse, there's some strategies you can take advantage of. I'm kind of jumping all over the place with these IRAs, but the gist is if you're married, you can inherit retirement money as your own. Same rules would apply to you if you're under 59 and a half. If you're over 59 and a half, the 10% penalty goes away. You can take distributions out. You just pay taxes on it. If you're under 59 and a half and you need the money, we can structure it as a Benny IRA, and you can take those penalty-free distributions, move the money back over whenever you're 59 and a half, and then continue your distributions, again, without penalty. So there's a couple different things you can do. But if you are a non-spouse, the only option you have is to take, well, actually, that's a lie. Let me go back. You can stretch an IRA, a beneficiary IRA, if you're within 10 years of that person who passed away's age. They do allow exceptions for that. Depending on your age and your relationship dynamic, you might be able to continue and stretch that IRA over the course of your life. But if you're less than 10 years, or if you're more than 10 years younger than the person who passed away, you're going to have to take the account out within 10 years of inheriting it. So there's some nuances. The IRS does not make it easy to understand. I'm even getting tripped up as I'm sitting here talking about them, but it's going to be something for a financial planner to review as you're thinking about your own financial plan. The other thing is, I mentioned the tax-free asset transfers, that you can actually do this while you're alive. If you want to transfer assets between spouses to hold in your own names, you can do that, and there's no penalty, there's no amount, there's no limit on how much you can give to each other every single year. Versus if you're not married, those are going to be considered gifts to each other. And there's limits on how much you can gift each year to stay below the IRS's threshold. For 2026, I believe it's $19,000 that you can gift to one single person per year before you have to start filing gift tax returns with your taxes. Now, that's not to say if you gift $25,000, that's not to say that you're going to owe taxes on the remainder of that above $19,000, but you at least have to let the IRS know that you did that. So it can just be a little bit of an administrative headache to give money back and forth if you start to go over that gifting limit. So that's something else to consider, is you can transfer assets back and forth. And I don't know why you would, but you never know. There might be situations where you need to fund emergency funds or something like that. You don't want to keep, joint bank accounts, something like that, and you're sending each other money, whatever. But you can gift each other an unlimited amount of money each year if you're married. And the other thing too is with gifting, if you're gifting money to, let's say, a child or a grandchild, the other thing that increases is the gift tax exclusion, which is, again, that $19,000 per person. But whenever you're married, you can actually double that limit. So per person, per beneficiary, you can give up to $38,000 a year to an unlimited number of people before you have to, again, let the IRS know. So if you have 7 grandchildren and you want to give each of them $38,000 into a 529 plan, you can do that for an unlimited amount of times and not have to let the IRS know. So if you're thinking about your estate planning, you're trying to get some money maybe out of your own estate, this can be a good strategy to take advantage of, to gift that money away, not have to let the IRS know about it, and then it's for the benefit of somebody else. So keep that in mind. And then there's also the lifetime exclusion, which is about what is it this year? 15, it's 15 million for 2026. And if you gift up to 15 million, you won't owe any gift taxes over your lifetime. And then that limit doubles for couples. So you can basically pool your gift exclusion together. The lifetime exclusion amount is what it's also called. But you can pool that amount together and you can gift up to $30 million before you're going to start owing gift taxes. So it's a pretty darn good benefit. Now, 15 million is still really, really high, but there's a chance that after Trump is out of office, that may reset. Trump is the one who's kind of been extending all of these limits on some of these things. He's the one who's kind of made this exclusion really, really high. But if if we go back to pre-2016 rules, that exclusion may go down and it may start affecting more and more people, because I think before it was maybe around $1 million instead. So now we're getting into a territory where more and more people might start to owe gift taxes or estate taxes, because it applies to estate taxes as well. If your estate is over that $30 million to pass on to somebody else, you might start to owe estate taxes as well. So there's an unlimited spousal transfer, again, that can be had, so you won't use up any of your lifetime exclusion amount whenever the first to die spouse passes away. It's the second to die spouse that might be the problem, depending on, again, the size of your estate. Most people won't have to worry about this for now, but it depends on what the exclusion amount is going to be in the future. For now, it's not a problem, most likely. But for the ultra wealthy, can be a problem, but there are trusts you can set up, and there's other measures you can take to protect against things like that and shelter some of those assets from that estate tax. So just all something to keep in mind, something to definitely talk about with an attorney if you're in that ultra high net worth bracket. But for middle class America, probably isn't going to apply right now. The other thing is a surviving spouse is automatically the beneficiary of a deceased spouse's 401k. So if you are not married, that could be an issue as well, because then depending on you usually on retirement accounts have to put someone as a beneficiary. But if you for some reason don't, and that asset has to go through the probate process, you're not considered next of kin if you're not married. So if you have a child from a previous marriage, the child is probably going to inherit that 401k versus you as the partner. So if you're a spouse, you don't have to worry about that, because hypothetically you'd be their beneficiary on all their accounts. But if you weren't, you'd be the next of kin to be able to take on those assets. Same thing goes for your healthcare decisions. If you become incapacitated and you can't make decisions for yourself about your own care, your spouse is next of kin. So they can make decisions on your behalf if something happens to you. It's not a bad idea to have powers of attorney listed just in case, and backup powers of attorney in case something happens to that person, they're unreachable, whatever, if they're incapacitated too, that you want to have someone else in mind in case you have a situation where both of you are incapacitated and need to have someone else make your decisions for you. But if you're not a spouse, again, you're not the next of kin. So having that power of attorney document is going to be and healthcare directives is going to be really, really important to have in place to make sure that your wishes are respected whenever it comes to healthcare, that you're getting the care you want. You want a DNR? Great, put it in writing. You do want to be resuscitated? Put it in writing, because the next of kin is not going to be your partner. And then last but not least, one of the main things about getting married is the fact that you're going to be a unit. You're going to be in unity with each other whenever you're getting married. You're making, again, a legal commitment to this person that I'm going to spend the rest of my life with this person. So you want to be on the same page, and you want to marry someone who's on the same page with you about a variety of things, right? You want to be on the same page about your religious beliefs and how you're going to raise your children. Political affiliations matter to a lot of people. How you think about finances is going to be a really, really big one, because one of the main causes of divorce in this country is financial strain, financial disagreements, finances in general. So you want to be on the same page. You want to have these uncomfortable conversations with that person before you get married, because you want to make sure you're on the same page, that you're on the same team, because marriage is going to be difficult, but it shouldn't be this really, really hard mountain that you have to climb every single day. Theoretically, two people rowing in the same direction should make rowing the boat easier. You're still maybe going against the current sometimes, but you're not just going by yourself. You have another person there who's also rowing in the same direction. So hypothetically, again, it should be easier to row, but you're in the same boat, right? So let's make sure we remember that if there's issues that are going on in the marriage, we want to address those before we get married. I'm talking about big issues, big incompatibilities. And if that person isn't the one for you, then it's okay to go your separate ways. But I hate to see people not have these conversations with their potential spouse. and then get into a situation where they had no idea that this person had all this debt. They had no idea this person didn't think the same way they did about X, Y, and Z topics. So you want to have these uncomfortable conversations before you get married so you're on the same page. Because when you're rowing in the same boat, the boat shouldn't have a hole in it. If you have something that happens, you have an external factor that's happening that's causing issues, you should be on the same team. It shouldn't make the problem harder. You're both on the same team. It should make life is hard, but marriage shouldn't be the thing that is hard. You should be on the same team tackling challenges together. So keep that in mind. I'm not a marriage counselor, obviously, but just remember that there's the social aspect of marriage as well. You want to have similar social beliefs. You want to think about a lot of things in similar ways. It's okay to have disagreements, and you don't have to agree on every single thing because you're two independent people. But you want to make sure that the big things that matter to you, your deep core beliefs, that person shares those, because it's going to avoid a lot of disagreements. I find that budgeting with married couples can be a little easier sometimes because hypothetically you'd pool your assets together, as I mentioned before. You're pooling your bank accounts together so that all of your paychecks come into one account. And then from there, maybe you divvy them up into a savings account, something like that. You have a Christmas fund, you have a vacation fund, you have, all these different, however you account for money is easier whenever you're both looking at all of your resources together versus I know that sometimes people have like a his, hers, and ours account. And sometimes that's helpful too, because if you want to buy Christmas presents for the other one, you don't want them to see the statement and know what you got them for Christmas. So I can understand having a his, hers, and ours bank account as well. But in my mind, a majority of your paychecks should be going into that joint account where all of your assets, again, are pooled together. We're on the same page. We're paying off debts. We're getting traction on all of these payments that we're making. We're pooling together, again, more resources than if we were single. And we're making strides every day towards those bigger goals. We're putting more money towards a down payment. We're paying off one of our spouse's student loans, we're paying off cars, we're doing all these things that we want to do. We're starting emergency funds, we're starting funds for 529 plans for kids. We're tackling goals, again, together. That's the big thing, is we're tackling these things together. And joint financial planning, again, I don't want people to go into a marriage not knowing the finances of the other person, because financial infidelity, financial lying, those are big things where the other person doesn't want to be embarrassed or outed by their spouse. They don't want to be yelled at by the other spouse. But it's meant to be a conversation about transparency, and it's not meant to be a judgment conversation. But that's going to obviously come with personalities. But sometimes if you need almost like a financial mediator in the mix, where you come to a financial advisor and we hash out everything you both have, it's going to benefit you both in the long run. Because if you do have hidden debts that you don't want the other person to know about, that's not benefiting anybody. It's just causing resentment towards the other person. It's just going to be a bad situation over time. If you have hidden gambling debts, these are things that you want to address, right? And you want to, if you need counseling to get over something like that, an addiction of some kind, I obviously want you to get the resources to combat those addictions so that you can, again, go into the marriage healthy and on the same page with that person so they're not feeling resentment. Now, ladies, I don't want to say this doesn't apply to men, but ladies, I do caution against the pooling of finances, especially if you're young. I do think it's important for us to have separate accounts just in case something happens, because there's a lot of abuse that goes on, especially with women. And again, I don't want to say that men are not immune to being victims of abuse, but a lot of the times women are the ones who would be financially exploited. Maybe you're not working, and the other spouse, your husband, is working, and you don't have any financial skin in the game. And so when you're giving that other person the power to feed you, you're giving them the power to starve you as well. So I don't want to advocate for one way or the other, but I just want you to keep that in mind. And again, is this going to apply to every situation? Absolutely not. But if you're noticing patterns of abuse and things like that, I would highly encourage you to have your own account so that if something happened and you needed to get out of that situation, you are not left with nothing. So I'm trying to prevent all of the unforeseen circumstances that could happen in a marriage. And again, men, I'm not saying this isn't going to happen to you, but women are usually the ones who are victims, unfortunately. So I want to have those conversations with women as well, of making sure that if something happened, you are taken care of. And then let's talk about some drawbacks real quick. So if you're married filing jointly, depending on your income, it actually might bump you up into a higher tax bracket. Let's just call it how it is, depending on income. Now, again, those brackets are really, really high. They're really stretched out, but there's still a chance if both of you are high income earners, you're doing really well in your careers, that it might bump you up into a higher tax bracket. Unfortunately, kind of is what it is. But if one of you is a lower income earner, other one's a higher income earner, it actually might benefit you to be married, because the person who's the higher income earner actually might see a decrease in their tax liability. So potential drawback there. Obviously, if divorce comes into the mix, potential drawback of pooling your funds together. But if you're a young couple who starts out with not a lot, divorce may not be that large of a deal financially, depending on what you have saved up over the course of the marriage, depending on how long the marriage has lasted, all of that good stuff. But a prenup is never a bad thing to have. I think some people shy away from it because I feel like they think they're going into a marriage with the expectation they're going to get divorced. But if you come from wealth, if you're expecting a large inheritance, if you have built up your own wealth and you're concerned about that at some point and you want to protect yourself, it's not a bad thing to have that. It's really not. I don't think it's that big of a deal to have it because, again, life is unpredictable. We just don't know what's going to happen. So you can also do a post-nup after you get married. So if you get married, you find that you got a large inheritance, or you got a really substantial raise, you became a business owner that really blew up on TikTok, whatever, and you want to get a post-nup and you want to protect yourself, you can also do that. But again, you both want to be on the same page about that, because that could be a point of contention too if the other person doesn't agree to a prenup. Why do you want that? What's going on here? But it's just, again, it's another way to protect yourself against some unforeseen circumstances. And I don't want people to get divorced. And if you never get divorced, it doesn't matter. But just having it in place may give you a little bit of peace of mind about these things that are going on, because otherwise, if you get divorced and you don't have a prenup, there's a really good chance the assets are going to be split in half. What do we do with the house? What do we do with our pets? What do we do with the kids and custody? And who's going to pay each other alimony and child support? So there's a lot of back and forth that's going to go on in a divorce, but a prenup could potentially help to smooth some of that out, or protect, again, both of you in the event of a divorce. And then just one last thing. I feel like I mentioned this, but I just want to say it again. If one spouse has bad credit, it actually could affect your loan terms, interest rates, car insurance, things like that. So credit scores matter. It's kind of this fictitious thing that we've put into place that kind of rules over the borrowing industry, but it's not fictitious to the bank, obviously. It's kind of this fictitious concept that I have this certain score associated with me as a person and how I am as a lender, but banks need to figure out a way, like a rating system almost, for how it deems you to be a responsible borrower versus not a responsible borrower. So if the bank thinks one of you is an irresponsible borrower, it may affect your rates. So this is a lot to think about, and I don't want it to be doom and gloom, because I love marriage. I love love. I want you to have a prosperous marriage, but it's a big commitment and it's a lot to think about. So I want to be, again, I hope this was a good resource for you to think about as you're taking that next step in life. If you've been with someone for 30 years and you haven't gotten married, it might make sense to just go to the courthouse and just legally get married. You obviously have a lifelong commitment to that person, but it's not on paper. So the IRS doesn't know about it. The law doesn't know about it. So for the estate planning purposes, the tax purposes, all of these different benefits that I mentioned, it might make sense to just go to the courthouse and just make it official. So I hope this helps. If you want to get more information about any of these topics and how they might apply to your situation, give us a call. Number is 724-733-4334, and we will see you on the next one. It's Watch Your Assets on all social media platforms. Give us a like, give us a follow, and like I said, we'll see you on the next one.